Welcome to this month's monthly market update. I'm Damon Greywall, Senior Relationship Manager at Frontier Advisors. I'm joined by Shahana Mukherjee, Senior Consultant from our Capital Markets and Asset Allocation team. How are you, Shahana?
I'm doing well, Damon. How are you?
Very well, thanks. A lot of data to potentially digest again, and key central banks making decisions over the course of the last few weeks. So a lot to go through. Curious, can you talk through some of the major central bank policy decisions that came out in the recent weeks?
Certainly, Damon. So as you mentioned, it's been a busy month for central banks, and we saw most central banks keep their rates at restrictive levels up until the early to mid-months of the year. But we're also now starting to see some central banks transitioning to the next phase of the monetary cycle, which is the easing phase of the cycle. Now, among the largest central banks, of course, we saw the European Central Bank, which cut its key policy rates by 25 basis points earlier this month. And this was widely expected by markets, particularly following the central bank's messaging or signaling in recent weeks. And so with this rate cut, they become one of the major central banks to actually cut their very restrictive rates. And this also marks the ECB's first rate cut in 5 years. And at the same time, we've also seen the Bank of Canada proceed with its first rate cut, also worth 25 basis points in June. And this also marked their first rate cut in the last 4 years. Now, comparing the ECB and the Bank of Canada, we also have the US Federal Reserve, which actually left its policy rate unchanged in the month of June. So the Fed funds rate target range was maintained at your 5.25% to 5.5% range at their June meeting, in line with market expectations. And finally, earlier this week, we also saw the Reserve Bank of Australia leave the cash rate steady at 4.35%, as expected.
Yeah, very interesting. That divergence in central banks seems to continue in the decision making. What do you think is driving that difference, and how do these decisions change the interest rate outlooks across markets?
Certainly. So there are a few considerations supporting these decisions, but a lot of it is centered around how inflation is behaving and also the confidence that the central banks have around the short-term inflation parts. So just starting with the European Central Bank, we saw the ECB cut its rate, and part of the reason which motivated the rate cut was that they had seen noticeable and quite visible progress in lowering of the headline rate, particularly since August or September last year. Now, this did seem to suggest that underlying inflation pressures had eased, and it also provided some confidence that overall price pressures have not only weakened but are likely to continue being on a downward trend. And just from the central bank's perspective, moving towards less restrictive settings there are benefits associated with it, and that it will be important in stimulating economic growth. This is especially important for Europe, particularly given the region has seen somewhat stagnant growth through 2023. And at the same time, though, it's important to understand that what we've seen up until now has just been that one rate cut, and that by itself does not signal a whole lot about either the timing or the extent of future rate cuts that could take place, particularly over the next 3 to 6 months. The region is still facing fairly high wage growth, and we could start to see consumer spending pick up, particularly if real incomes improve. And at the same time, the element of uncertainty around energy prices, which have been a volatile element, or other components of inflation could also play out in different ways, which is to say that there could be a variety of factors which could still maintain or sustain price pressures, at least in the short term. And so for this reason, although the ECB has initiated the rate cut, in many ways, if you compare it across central banks, they also continue to see the risk of a slow decline in inflation. And this is something that's reflected in the fact that the ECB actually upgraded or upwardly revised the inflation forecasts for 2024 and 2025, just alongside the rate cut that they've delivered this month. Now, comparing that to the factors behind the US Federal Reserve's decision to keep rates steady, now the central bank has actually seen somewhat slower progress or limited progress towards lowering inflation in recent months. And while there are some signs that the US economy is past its peak growth, we're starting to see labor market conditions gradually easing, particularly if you look at job openings, which are continuing to come off its peak. And at the same time, we've seen the unemployment rate increase, particularly if you compare in year-on-year terms. There's also been evidence that the current market continues to be fairly tight, particularly if you look at job gains. Job gains are still fairly strong, which is to say that, at an overall level, at least, the labor market continues to be fairly tight. And this is an element which continues to keep, some sort of uncertainty, at least in the short-term inflation outlook. And so the Fed also continues to be cautious against potentially lowering rates, particularly at this stage of the economic cycle. Now, comparing these decisions to the RBA's considerations, the RBA's decision to leave the cash rate steady also came against the backdrop that inflation is declining more gradually, and the central bank has seen evidence of slowing economic conditions domestically, but some of the recent data have been more mixed, which is to suggest that there is still a risk that inflation could prove to be a bit persistent, at least in the short term. And then there's also the unknown impact from the planned tax rate cuts, but also the energy rebates, which are going to come around shortly. And there are questions about what that would mean in terms of future consumption growth, particularly in per capita terms. So these are some of the considerations that central banks are dealing with in assessing what would be the right time to lower interest rates.
Yeah, very interesting. And I think in terms of the RBA, they kind of mentioned stubborn inflation. That was a key word that really stuck out for me. And looking at the chart back, the key thing that sticks out in the GDP component is really our government spend as well. So a lot of information there across, various central banks. How have the expectations for rates changed as a result of more recent data?
So I think it can be said that market expectations have generally become a little more moderate over the past few months in response to these decisions, but also in response to the new economic forecast that central banks have published. So just thinking about the Fed expectations around the Fed rate cuts, the current pricing suggests the possibility of one or maybe even two rate cuts by December, followed by more meaningful rate cuts, which are likely to happen in 2025. But the current pricing does suggest that the Fed funds rate is likely to settle at around 5% by the end of 2024. As for the cash rate, now market expectations for rate cuts will continue to be fairly modest, if any, for 2024. And the current pricing actually suggests that cash rate cuts are likely to start or begin only in the early months of 2025. And finally, thinking about the European Central Bank, which has already begun cutting its rates, the current pricing suggests the possibility of maybe two more rate cuts by the end of this year. And so what we see is the scope for potentially some of this divergence to continue over the next few months if the planned interest rate moves match what is being expected by markets.
Yeah, very interesting overall, and it's interesting to see across Australia, US, and the EU that real rates remain, which is relatively new proposition for markets if we look back 12 months or even 24 months. So much more to look forward to ahead. So thank you for joining us for this month's market update, and we look forward to serving you in the future.